trade. Now, Mikey, maybe you can give people a little bit of your background on how you trade options and how you defend options trades, because you have done a ton of work on the mechanics side and staying true to those mechanics and educating people on defensive mechanics, which I think are probably the most important part of your mechanics toolbox, because if everything goes well, you don't need, you take profits, right? Like you sell something, you buy it back for profits. No real mechanics needed, maybe a little bit, but not so much. When you're looking at an option strategy, Mikey, such as the short strangle, and the market just rips higher, what are your mechanics there from just a very basic, broad level? And then we'll get into futures.
So I think the biggest difference between options trading and futures trading is simply that with an options trade, you can roll, especially if it's an undefined risk trade, you can roll that position forward in time and you're going to collect a credit. You're going to improve your basis on the position because it is a dynamic delta position, because there is extrinsic value. So when you're trading futures, especially when it comes to defending a day trade, one thing that is true for both futures and options trading is that we need to trade small, because I don't care how good you are at futures trading, I don't care how good you are at options trading, you will run into a situation where you were not only a little bit wrong, but a lot of bit wrong. And maybe you're in, the 2-year on Friday and you were short the 2-year. Now you see this 3 standard deviation move to the upside. If you're trading too large, that's going to be problematic. But if you're trading small enough and you have the ability to hold that position, I think the number one defense is trading small up front. But second to that is going to be setting up basically a realistic risk reward situation where, like with the spread we just looked at in Apple, if you have a defined risk spread on, you can make $280, you're risking $720. Maybe you're okay with that. You've got 60 days for it to work out.
Sure.
It's basically like having a position in a futures product where your target is $200, but you're willing to accept a $700 loser. And for me, I think with futures trading and static delta and creating these stop losses, if you will, versus what your expectation is, it definitely helps if you have, if you're tracking this yourself. Like if you're day trading and you realize, okay, over the course of the year, my win rate is, 30%. So ideally, if you're taking $100 loss and your profit target is $200 or more, if your win rate's 30%, you're going to be at break even or maybe a little better if you're doing that sort of risk analysis. So there's so many layers to it, but the biggest thing I think is, first of all, trading small, which is why the small exchange is amazing, because you have the ability to trade really small, hold through really big moves like you're seeing in the 2-year. But also you need to be able to set up stop losses and learn when, this might be a good time to exit the trade, look for something else.
Absolutely right. And we're going to set up the foundation for that second piece, which is essential, because the first piece, you have small exchange futures, and these things move between $10 and $100 on the average day. So really small enough for you to get in there and not feel uncomfortable from the start. Because the best trade defense happens before the trade. Get small and either scale into a position or just be able to withstand a 1 standard deviation, 2 standard deviation, even 3 standard deviation move like we're seeing today from the outset. But that second piece is essential, and we're going to lay some foundation for it today, because you have to, it's a combination of, what is your success rate looking like? And then in accordance with that success rate, if you're winning 30% of the time or 60% of the time, you're going to have to be setting up realistic stop losses on your losing trades relative to the profits that you're taking. But let's kick it off with crude oil being the example for today, because in my mind, crude oil, Mikey, is one of the best trades for day trading. It's definitely one of the most commonly day traded markets out there, probably after, your basic stock index futures. And why is that? Well, because this market takes huge swings, but it does conform to a historical range on a yearly, monthly, and daily basis. This is one of the really beautiful, in my mind, beautiful markets, Mikey, because you see on a day, you could see a move in crude oil of $3 or $4, but in the course of history, this market has stuck within a range like almost to a fault. This market has not seen the upside drift of equities where it's like, oh yeah, back in the early aughts, crude oil was $30, and then in 2010 it was $60, and now today it's $100. No, this thing takes big rips on a day-to-day basis. But the upside of the range is pretty much just north of 100, and the downside is 0. And you see all the back and forth there in between, right? I mean, that's what day trading is all about, is something that kind of conforms to some semblance of a range, but intraday is seeing big swings.
Yeah. And I think that, again, like we said in the beginning, is a requirement for day trading and looking for realized moves that, actually happen versus, trying to get into something and then you get a couple pennies or a couple ticks and it's just not enough. And, you're barely, making it interesting, to say the least. So I definitely like crude oil as one of the products to look at for sure.
Absolutely. And we have plenty of examples of this market moving in those big intraday swings. But I just want to look at actually last Wednesday, market really tanking in crude oil all last week, Mikey. But Wednesday, November 17th was a particularly volatile day. And you can see here, like Mikey says, price action is what drives opportunity and drives where you want to enter. Like if there's a market that moves 3 or 4 or 5 ticks per day and you're going to try to day trade 2 ticks, that's a tough one. But you have here a market that started at 79, fell all the way to 77, and then bounced back a little bit. What we do, though, to kind of gauge where the opportunity is we look at these standard deviations. And in crude oil, what's really nice is because this market has a really deep and consistent historical range going back this last several decades, the daily range is usually around $1.25, maybe $1.50 when it's particularly volatile. And so you can see here, I pose a potential buy when the market is down on the day on Wednesday, $1.25. Now, defense for this trade, you almost have to have your defense in mind before you click buy or sell for a day trade. And with that in mind, my defense for something like this, I'm a trader who likes to look for edge that gets my success rate north of 50%. I'm hopefully at the end of the year winning on 55 or 60% of my day trades thanks to standard deviations and other metrics. And so with that in mind, I have to have a pretty quick leash on my losses, Mikey. I can't be risking more than I'm making on every single trade here. And so with this in mind, if I buy the market down $1.25 and I'm looking to take 50 cents out of that market, if I buy the 78 evens and the market gets down to 77.5, like it did here, I have to sell out of that position and get out for a loss on that trade because, like I say, I'm looking to win 55, 60% of the time. And if I was going to look to make $50, but then risk $1 or $1.50, the numbers don't come out right at the end of the year. And so this would have been an example of a loss here. And unfortunately, it's really not that complex. Fortunately and unfortunately, it's not complex defending a day trade, right? It's a matter of you're trading for the day. And so defense is just going to look like taking losses at that predetermined level so that all your success rate and other statistics come out making sense.
Yeah. And that's literally the biggest thing. And, making sure that, like you said, if you're expecting 55 to 60% winners, how does that match up with profitability at the end of the year with 2,000 day trades? Or I guess 252 day trades if you're just doing one. But really, that's the biggest thing is realizing, what am I willing to risk with this position? What is my target win? And where's my entry point? Looking at the standard deviation, like you said, if it goes from 79 to 78, or even if you were looking to enter it at a multiple of standard deviation, maybe you're really trying to be conservative and you're looking for those moves outside of the one standard deviation range. maybe that helps your win rate, maybe not, but still determining what your strategy is, sticking to a plan, especially with static future day trading, I think is super important because emotions can creep up quickly when you have a shorter time frame for a trade.
Absolutely. And what's really relieving about day trading, and I know this seems simple, but the fact that defending a trade by simply taking a loss that was predetermined as a function of your success rate and the profits that you take, what's really relieving is you can move on to the next trade in this market or another trade in a different market very quickly and not have to worry about, oh man, I'm taking a lot of heat in that crude oil trade. If you wanted to, this example that I chose here, market starts at 79, sells off to 78. I buy it. I get out for a 50-cent loser, then drops down to 77. I have the ability to pick that market back up down at 77. And what I did there is I avoided another 50 cents of losses by taking the 50-cent loss at 77.5 and then getting back in. And so really relieving stuff here. And like you say, it's got to make sense with your numbers, because I know a lot of people out there, wait for 2 standard deviations to get into trades. And so maybe your success rate is 70% or 80%, and you feel comfortable taking losses that are, 2 times what you take in profits. That's totally fine. Or you take big swings and you're only right about 20-30% of the time, but your winners are 3-4 times as big as your losers. Whatever makes sense for you at the end of the day. Just a good place to start is the standard deviation here, getting a good gauge of the market, and then defending your day trades by taking losses. That's about it. That's as easy as it gets, right?
Love it. Couldn't agree more.
Absolutely, man. Yeah, I know options are fantastic because you have so many different options to start out with and then also defend over time. You can roll it out for credits if you're short and so on and so forth. But it's really relieving at the end of the day to look at your futures day trades and just be like, man, it's 3 p.m. or 4 p.m. Central time, and I'm not dealing with any losers because I got rid of all of my losers by defending them during the day. So great stuff as always, Mr. Butler. Thank you so much for joining us here on the Monday Running with the Bulls segment. I guess we'll start calling it here. Yeah, absolutely. But anyways, I must jump now because we have Splash into Futures coming up next. Very, very interesting. One of the most interesting days we've had here to start the week in futures in a while. I know Peter Momat's going to have some ideas on every asset class. So stick around, everybody. And thanks for watching Small Stakes. Peace.
Peace.